All right, today on Talk Tickers, we are digging into Regional Management Corp, ticker RM, and this one's a real head-scratcher. Their third quarter earnings report looked, on the surface, absolutely fantastic. But then you look at the stock chart, and it tells a totally different story.
So let's get right into the big question. How does a company post record revenue, an absolutely massive 87% jump in profit year over year, and then the next day, the stock just gets hammered, down over 10%? I mean, what gives? What did Wall Street see that most people missed in those headlines? That's exactly the mystery we're going to solve right now.
All right, so first up, let's just lay out the evidence. We're talking about a quarter in total conflict with itself. You've got these amazing results on one hand and this really harsh reaction from the market on the other.
And this slide just lays it all out perfectly. You've got the good versus the ugly. In the good column, I mean, come on, it's everything you'd want to see as an investor. Record revenue, record profit, and their operating expenses as a percentage of revenue, a record low. That's just beautiful execution. But then you look at the ugly column, and that's what sank the ship. A tiny miss on earnings per share, that brutal 10+% drop the next day, and, crucially, some cautious guidance for the future.
And when you zoom in on the numbers, you really see how wild this is. Look, on revenue, they crushed it. Wall Street was looking for about $160 million. They came in at over $165. That's a solid beat, but look at the earnings per share, the EPS. The estimate was $1.46, and they came in at $1.42. We're talking about a 4-cent miss. In this kind of jittery market, that's all it took. That was the trigger. So you have to ask, where did that miss even come from?
Okay, so let's get our detective hats on and unpack these numbers, because this is where the story gets really interesting. The key to this whole puzzle, the reason for that earnings miss, it's not a sign of weakness at all. Actually, it's kind of the opposite. It's hidden inside their own success.
And here it is. This is the culprit right here, an extra $35 million. What is that? Well, their loan portfolio grew by about $35 million more than they even expected. So demand for their loans was just off the charts, way better than their own internal forecasts. Now you'd think, wow, that's amazing news, and it is. But because of some quirky accounting rules, this amazing news actually dinged their earnings for the quarter.
And it all comes down to this one term, the provision for credit losses. So here's how it works in simple terms. When a lender like Regional makes a new loan, accounting rules say they have to immediately put money aside, like an expense, to cover any potential losses on that loan down the road. So when they suddenly made an extra $35 million in loans they weren't planning for, they were forced to take an immediate unplanned expense hit. And that hit, after taxes, was about $2.7 million. That's it. That's the entire 4-cent EPS miss, right there. So get this, they missed earnings not because the business was bad, but because business was too good.
And if you just ignore that accounting quirk for a second and look under the hood, this quarter was an absolute banger. I mean, check this out. Their operating expense ratio, best it's ever been. Their digital business is on fire, making up over a third of new loans. That barbell strategy you hear them talk about, it's working. Their auto-secured loans grew 41%. And maybe most important of all, their actual loan losses, they went down year over year. Oh, and the cherry on top, the board authorized a big $60 million stock buyback. That is a massive vote of confidence in their own stock.
Okay, so if the quarter was actually so strong operationally, then why the 10% drop? Well, as we all know, the market doesn't drive looking in the rearview mirror. It's all about what's coming down the road. And for regional management, a trifecta of uncertainty just appeared on the horizon. And here's uncertainty number one, the guidance. This is what really spooked investors. Management basically said, hey, that record quarter we just had, don't get used to it. They're forecasting net income to drop almost 17% in Q4 compared to Q3. And they said that amazing loan growth we just talked about, that's going to slow way down too. So the market heard one thing and one thing only. The best is over and a slowdown is coming.
Uncertainty number two. A new captain is taking the helm. At the same time they released earnings, the CEO, Rob Beck, who's done a phenomenal job growing this company, announced he's retiring. Now the new guy, Lakhbir Lamba, he's coming from PNC, he's got a great resume, seems like a solid choice. But you know what the market hates more than almost anything? Uncertainty. And a new CEO, no matter how good they are on paper, is always a big question mark until they prove themselves.
So let's connect all the dots here. You've got this operationally fantastic quarter that was tripped up by a weird accounting rule. And then, bam, at the exact same time, you get hit with weak guidance and a CEO change. It's the classic investor's dilemma. What do you pay attention to? Well, the market's verdict was swift and it was brutal. It completely ignored the great Q3 results and focused 100% on future risk. It saw three things. Number one, uninspiring guidance that screams slowdown.
Number 2, a new CEO, which means new uncertainty. And number 3, let's not forget, this is a non-prime lender. Investors are already nervous about the economy and the consumer, so any hint of trouble with a company like this gets magnified. The bottom line is, the market didn't sell the past, it sold the future.
Okay, so that explains why the stock dropped. Now for the fun part. What happens next? It's time for the next call, where we give you our take on the next quarter, the price action, and our official rating.
All right, here's our call. For Q4, we think they'll meet or probably even slightly beat that lowered guidance. Management is clearly playing it safe, setting a bar they know they can clear. As for the stock price, we think it's going to be stuck in a range for a bit, probably bouncing between $35 and $42. You've got the strong fundamentals and that buyback putting a nice floor under the price, but all that uncertainty we talked about is going to act as a ceiling. So that brings us to our official Talk Tickers rating. We're calling this a market perform. The stock seems fairly priced right where it is, balancing that solid operational strength against the risks on the horizon.
And that rating leads us directly into our trade idea for this one. Think about it. The market freaked out and sold the stock because of uncertainty. And when that happens, the price of fear, what we call implied volatility, goes way, way up. So, if you believe the underlying company is solid, you get this cool opportunity. The market sold the uncertainty, so the trade is to sell the volatility.
So what does that mean in practice? Here's a trade idea to think about. With all that fear pumping up the price of options, you could consider selling cash-secured puts that are out of the money. Basically, you're getting paid a nice premium right now because everyone else is nervous. You're selling insurance to the worriers. If the stock stays above your chosen price, you just pocket that cash. And if it does happen to fall and you have to buy the shares, well, you're buying a really solid company at a discount, a price you were already comfortable with. It's like getting paid to put in a lowball offer.
And of course, we always have to say it, this is not financial advice.